welcome. My name's Tristan, and today we're going to be interviewing part of our investment team. So with us, we've got John Jones and William McBride. The aim of this is sort of to give you an idea of what's happened over the last year, what changes the investment team have recently done, and what we anticipate is likely to happen from that. So to start us off, I'm going to hand us over to John, and John's going to tell us a little bit about what's happened in the last year within the portfolios. So John?
Good morning. So 2023 was an interesting year in markets. And not only that, it was an interesting year socially, economically, politically. So instead of giving a chronological breakdown, I thought we'd give a brief breakdown of things that happened in the market and try and cover a little bit of each area of the globe. So we'll start with China. Very interesting year for China in 2023, ended at zero COVID policy, which is quite big news considering they're a major exporter to the developed nations. Also, the president was re-elected for a third term, which is unprecedented, to be honest. Over in the US, they also had a very interesting year. They had the debt ceiling issue, which we won't go too much into detail, but it was a major issue in bond markets. They also had their government bond downgraded. It was downgraded from a AAA to a AA, again, impacting bonds. And they also, on the flip side, they did have a good year in the market. They had massive earnings inside the US NASDAQ. Going over to the UK, we also had a very interesting year. So we had the coronation of King Charles III. We were marred with industrial action. Over in Europe, they also suffered strike action. We also seen some geopolitical issues. We've still got the ongoing Ukraine-Russia war. We have Israel-Hamas, and we do have rising tensions in China and Taiwan. They're still all ongoing, and they are a slight cause for concern, but the market has priced them in. On the positive side, though, 2023 was a good year for portfolios run by 24/7, all core models, 2 to 8. They all outperformed cash. And I should say they outperformed the Bank of England base rate, and they did all outperform CPI on a gross basis. So the year did end positively. There's massive factors why that was, but just from an overriding perspective, it ended positively. There was a huge impetus in Q4 2023 in markets, which there was a huge rally in all asset classes, to be honest. The rally was basically an optimism rally. It was because the US, there was belief the US was going to reduce interest rates a lot quicker than was forecast originally. So the US is the front runner, which a lot of other central banks run off. So there's massive rally, which is great news for the portfolios. It's only fair to say there was a slight pullback in January 2024. The optimism was dulled down a little bit. We are heavily reliant on data at the minute. So it's a month by month basis. And what's said one month could be proven wrong the next, because the next set of data is the most important set of data when it comes to interest rates and inflation. However, that being said, February 24, March 24 has actually kicked back on, and all portfolios actually, as of speaking today, sit in a positive territory as well on a gross basis, which is good. Just flipping back to 2023 events, it's fair to say one of the major factors, again, was interest rates and inflation. Most developed central banks, ourselves here, the US, the Eurozone, the concentration is on bringing inflation down. So it's a hard year economically in the fight to bring inflation down, which looks, touch wood, to be at the forefront of being done. This year will play out, and keeping a very close eye on that. But just to give an example, the UK base rate started 2023 at 3.5%, and it finished at 5.25%. So we over the globe, UK and the US, we've seen some of the most aggressive rate hiking cycles in modern times, basically. But I do think it's positive news, because we're now looking at the end of the rate hiking cycle. We're now looking for when, not if, rates are going to come down. And I'm sure we'll cover that later on, but we do expect that to be this year.
So obviously that sort of explains that last year, well, up until around about November was not great, and everybody knows why that was. And you've explained that very simply by reeling off a huge number of different events that occurred, and we have to add those all together and see what happened there. So that sort of leads us to where we are now. So every 4 months, you do a full investment review, and therefore we look at how do we change things around. The last one of those occurred back in November, sort of or late October, November, and obviously you've just done one. So I'm going to hand it over to Will. So Will, what have you sort of changed, maybe dialed up, dialed down in the portfolios this time? And I guess why?
I'll firstly touch on what sort of changes we made in October, which sort of helped the portfolios finish the year quite strongly. We did dial up the global equities, reducing the UK exposure at the same time. That's really helped sort of kick on with the US sort of pushing on towards the end of the year. Coming into this portfolio review changes, we've made quite a number of changes. I think it's 8 sort of changes on this one. Firstly, again, we carried on sort of reducing UK equities in favour of global equities. Again, this is sort of the main driver behind this. UK equities are really, really good for dividends. They pay a high level of dividends, which compound over time, which really, really help sort of at that base sort of driver of returns. Global equities are more growth weighted. So blending the two together, you do get that sort of nice style, blend between the two. So that continuation of that dialogue has really helped.
So now that we've sort of talked about what's happened, we need to know what we're changing and how things are going to go, perhaps going forward a little bit. So in March, you did a number of changes, obviously with the most recent investment review. So Will, do you want to start off by telling us a little bit about some of the sectors and things that we've changed and why? And then John, maybe you can add a little bit as well.
The first sort of sector change was the composition of the UK equity basket. Obviously, equities are stocks and shares. Prior to sort of this change, we've had 3 components to that. We've got UK large cap, which is like the FTSE 100. We've got the UK mid cap, which is the FTSE 250, and the UK small cap, which is smaller companies that are in the early stage of the growth cycle. We've got money in all 3 camps, but we decided to split that into 2. We decided to keep it with just large cap and mid cap. UK small cap exposure can be quite illiquid, which at times of market stress and with a bad turn of sentiment, it's not the best place to be. So we've sort of exited the UK small cap fund, and we've increased the exposure to the mid cap, which is, you've got a better liquidity profile there. So that's the change on the UK side. On global, we've dialed down the large cap exposure. And again, we've increased the global smaller companies on that side. Share prices have been hit quite hard in smaller companies. It's mainly sentiment driven. The company fundamentals, the performance has been really, really good from the companies, but it's just the sentiment shift which has downgraded the performance of these shares. So we believe the area is quite undervalued, and hopefully a re-rating will offer greater potential for returns going forward.
From that side, I'm guessing you don't have any concerns around the liquidity of the global smaller companies.
That's true. Yes, of course. Yeah. UK smaller companies are a lot smaller than global smaller companies, if that sort of makes sense, because a lot of them are US based. Although they're classified as smaller companies, they are still quite sizable companies worth many billions of pounds. So the liquidity profile is a lot better in the global space.
Great.
Yeah, just to jump in, sorry, as well. When we say sentiment is negative sentiment, so the fundamentals of the company as a business themselves, they're still performing well. They still have strong balance sheets, good cash flow. They've actually managed the negative 2022, 2023 years very well. The market doesn't price it very well for the sector, for smaller companies. And the reason that is, when we say sentiment, is the market is still very much concerned with high inflation, high interest rates. Once we see that turn, which we will be seeing some interest rate cuts as it stands in 2024, we do think the sector will benefit. And this global smaller companies sector, UK smaller companies sector, they should benefit well. You do still get that exposure in mid-cap as well.
Have you, as an investment team, made any changes, for instance, on the lower risk investments, such as fixed interest, gilts, government bonds, or gold?
Fixed interest side of the low risk portfolios, we have been increasing exposure to fixed interest, taking a little bit more sort of risk on that side of things, because yields have ticked up quite nicely. Yield is sort of like the interest payment that the bonds pay, and that's reduced. That's gone from basically near zero to sort of 4 or 5%. Much has, similar to what cash has done. So we're trying to pick up that increased interest payment. So over the last sort of 18 months, we have been increasing fixed interest, so you can benefit from that nice level of income. basically what's happened from interest rates going from virtually 0 to 5, not only has cash jumped in interest terms, but so has fixed interest, and so actually is dividend on equities. So it's almost like all ships have risen at the same time. So now we are starting to see that really play through and help the portfolios on that side of things.
Are there any other changes that you've made in the most recent investment review? Or
yeah, yes, there is. Yeah, we have made quite a number of changes this time. I touched upon the global smaller companies, which we've dialed up. We've also performed the same sort of same solution in UK large cap, US smaller companies. We've performed exactly the same task where we've sort of reduced the large companies, which have done superbly well. You know, you've got your companies sort of Google, Apple, Meta, that sort of thing, that have done it exceptionally well. But we've decided to take a little bit of profit off that and increase US smaller companies at the same time, because we just feel the valuation metrics are just so much more attractive at the moment on that side of things. Other changes we've done, we've reduced UK equities across the board at the last couple of reviews to increase the global exposure. We've got more in Asia and emerging markets. Emerging markets has been really hit quite badly in China, especially. And we feel we're starting to see a good recovery from there the last couple of months. So the increased exposure into the emerging markets has really helped things as well the last 4 or 5 months. Other changes we've made on the alternative space, we had quite a high allocation when interest rates were rising. Fixed interest wasn't a good place to be. Equities wasn't a good place to be. So the alternative basket was increased to soften the blow of, during the difficult times. However, now, fixed interest is a lot more attractive. We have dialed down the alternative exposure. So we've exited a couple of funds on that side of things. We've increased gold as well recently. We've had a gold holding for the last 5 years. Rather bizarrely, sort of gold miners has been hit really bad. At the start of this year, it was down sort of nearly 20%, but the actual price of gold was only down about 2%. So there's a huge difference there. So we've increased the gold mining exposure just at the start of March. We've already seen a nice sort of 12% bounce on that sort of fund already, which again has helped the portfolios. So that's good.
Excellent.
Yeah. I was just going to further what Will said. We exited 2 funds completely, as Will said, in the alternative space. We exited an absolute return strategy and a liquid real asset strategy. Basically, without getting into the details of them, they didn't perform how they were supposed to perform, and they also come at quite a high cost charge.
Yes.
So we decided to take the decision to come out of the funds completely because the landscape's changed. We can now get returns in a lot safer assets. So we've took the cost saving, we've redeployed into safer assets, and that's where we've gone with the alternative space, along with increasing gold. And as Will said, we've actually seen some quite good short-term returns on those decisions. Although, to caveat that, we do take our decisions on a much longer time frame, but it's still nice to have a short-term win.
Right. So I guess that sort of leads to, obviously, I know we don't have crystal balls and you don't have crystal balls and knowing exactly what's going to happen, but where do you sort of see the next few months, I guess, before the next investment review?
So I think 2024 does have a lot of room for optimism, especially in the fixed interest / bond space. We are essentially waiting for the first rate cut from a central bank. We believe it'll be the US and the Fed that does the first rate cut. We predict maybe 3 or 4 rate cuts this year from them, at probably 0.25% each. Again, caveat that with, if there's a market event that is likely to change, my words might change. It might be a stronger or a reduction in a cut, but this is just as we stand. Once the US starts signaling cuts, it's likely the ECB, the European Central Bank, they'll follow second, and we'll probably not be far behind third at the Bank of England for the UK. What happens is, once rate cuts are announced, it's a real big positive in the fixed interest space. Values will rise, essentially. However, there'll also likely be a feel-good factor across other asset classes, likely to see the property sector increase, infrastructure, which we hold, should increase. The reason being, just to keep it simple, is debt becomes cheaper. So businesses will benefit. Debt's cheaper, likely to expand more. likely to grow. It's an easier environment to grow, and the consumer, the general household, will spend less on debt. They'll have more in their personal budgets, which will encourage spending. So it's a win for the economy, and it should be a win for the stock market. They aren't correlated. One's forward looking, which is the stock market, and the economy's backwards looking, just to be clear on that. But rate cuts should generally be a good thing across the board. We predict probably June, to be honest, June, July time, summertime for the first cuts to start. It's worth saying the path to getting inflation back to where central banks want, it doesn't work in a linear pattern. So one cut doesn't necessarily mean 2, 3, and 4 will follow exactly the same. It's just a great indicator. It's heavily data driven, which we look at on a weekly basis, to be honest, but major data comes out monthly. And equities should likewise, stocks and shares should likewise continue its good rally if rate cuts do happen, because it's a more supportive environment for businesses to grow.
What you're sort of saying there, John, is ultimately we just need the Bank of England and the other central banks to start cutting rates. And as soon as those rates go down, of course, that affects cash rates, but actually it's going to be a positive thing for everything else.
Absolutely, yeah. It'll be an overwhelming positive once it happens. It's just the case that we seem to have been waiting for this point for 18 plus months. We're in the end period of the struggle with inflation. It's massively come down. What happens is when it comes down a lot quicker, but it hits a sticky point when the banks are looking to get to their target rate of 2%. It just becomes a bit stickier. So we're at that period now. But banks and the central bankers, they are forecasting and they are signalling rate cuts will be coming. So that's a positive for the market. It's just a case of when.
The data drives a lot of what sort of happens in sentiment, doesn't it? Whether the jobs data is released, the inflation readings, how growth is. It's at the moment the market is reading all these sort of signals month by month, and that's why you do see some fluctuations. But it's forward looking, so it's anticipating where the cuts are going to come, and the market prices them in sort of 6 months in advance a lot of the time. So it does look at the central case where things are at the moment. It's looking in a good place. We've got resilient economies, especially in the US, is sort of driving really well considering the interest rate rises, and inflation seems to be coming under control and getting into the right area. So that is helping portfolios. We have seen short-term rebounds, haven't we? Which is good.
I think it might be worth mentioning as well, because I think it might be a question that comes up to yourself, Tristan, a lot, is the UK did enter technical recession in the second half of 2023. However, to bluntly be speaking, data come out today to show that the UK has grown this year at 0.2%. So it's likely the recession's actually ended. Recessions, the word recession can be quite scary. Recessions come in all different shapes and sizes. And to be honest, the one experienced at the second half of 2023 was more technical in nature. And it was also expected, which should be talked about. It wasn't unexpected. So it's no huge cause for concern.
It should be a more positive year, even though it's already started positive.
Yeah, there's definitely room for optimism, especially going into the second half of this year. Just need a few more months of data to come out, positive data, and then we'll see where we are second half. But definitely room for optimism.
Encouraging, yeah.
Well, thank you very much for your time, and thank you for giving us that update. So big thank you to John and Will, and we look forward to doing this again in a few months' time when we do the next round of changes.